And this is the long-term look of the Nifty 50, which is the Indian equity markets. Now, this goes back all the way to 2007. And this is important because this is the period where we have the global financial crisis. Now, when we look back into those days, that period where the market was so stressed during the global financial crisis as a result of the subprime crisis in the States, now when we look back, it's only a little blip, okay? Now, even after the pandemic, there was this major sell-off during the early part of pandemic, which lasts only 1 month, okay? And then the market has now, look at it, it was under 10,000. Now you can see the index here is actually growing very fast. This is definitely a bull market in any kind of way you look at the market. This market is definitely in the bullish phase, okay? So this is the result. This is based on the daily time frame, and this is up to this afternoon. You can see that the market have a big sell-off, and this was the result of the election. The market wasn't expecting Modi to lose so much seat. Okay, going into the election, you can see market was actually at all-time high. And when the result came in that he only secured 272 seats, the market sell off in one single day. Okay, one single day, it dropped all the way to 21,000 from 23,000. So it dropped more than 2,000 points in one day. And based on this chart, you can see that this chart is the way I look at it is that I need to find directional buyers. There was a brief moment the market actually went into a very deep retracement. Technically speaking, this is where I will be buying, because when the market is in a bull market like this, I will not be able to chase, because this system that I have or I'm using doesn't allow me to chase the market. I only buy on pullback, and this pullback happened so fast on one day. It actually went into what we call a VDR. I call that a very deep retracements. Okay, so if we don't buy here, we don't have a chance. As we can see right now, as of this afternoon, the price is back to just under 24,000. And this will continue to edge higher. My target right now, projected target, is just under 24,800 points. So we still have another 1,000 points more to go before the market hit its projected target, and it may not even stop there. Okay, so this is how bullish the Indian market is right now. Of course, anything can change if the US decided to do something on their monetary policy front, especially if the Federal Reserve cut rates. This will be a rocket fuel that will take equity markets worldwide into fresh all-time high, and this will definitely benefit the Nifty 50. However, if the Federal Reserve decided to hold interest rate at this current level for extended period of time, it doesn't seem to be affecting equity markets around the world, because the market has more or less believe that they are calling the Federal Reserve bluff, meaning to say that they are very confident at some point the Fed will have to cut rates. Okay, so this is the current situation in which we are facing right now. But it's all seems to be working out very well for the Nifty 50. Okay, now this is the 4 hours time frame. Now, obviously, earlier on, I did mention in one single day on June the 4th, the market reacted negatively to the result for the Indian election. It went down to 21,281 and then rebound. Now, this is the futures contract, okay? So we want to see how this market actually reacted. The target remains the same at 24,800 thereabout, and we can see this as of this afternoon, the market have a new high at 23,842.9. Okay, so again, very, very bullish. Would I buy at this current level? No, I can't buy. But of course, if you can go down to a lower time frame, you can actually find levels to scalp. But always scalp within the green color bar area. If I want to buy, I must buy within this green color area. Prices has already left. So technically speaking, based on how I trade normally, I will not be chasing. Okay, so if you want to chase, you have to have a system in which you can manage the risk. Okay, so this is the other thing that we'll be talking today, which is the Indian rupee. So this is the convention. The dollar is worth $1. How many rupee do you need to exchange for the same $1? So the dollar over here in this currency pair, the $1 remains constant. That left side of the currency, the base currency, will not change. What changes is the currency, or we call the quoted currency, in this case, the currency on the right. Okay, so it is this currency that is actually moving. This one will stay constant at 1. So we can see that this is the conventional way of quoting dollar versus the Indian rupee, and it has been going higher, meaning to say that the dollar is gaining ground against the rupee, or conversely speaking, we are saying that the Indian rupee is losing ground relative to the dollar. Okay, so this is the conventional way of looking at it. Last I checked, this market is at 83.5466 rupees exchange for $1. So it means to say that the dollar continues to be strong relative to the rupee, and this has been the case year to date. The dollar has gained less than 0.5% against the Indian rupee. So it is not that bad because other currency has performed worse. Okay, but still we can see the trajectory is showing us that the dollar over time is going to consistently stay positive, because this one goes all the way back to 2003. You can see that the trajectory doesn't seem to be wanting to change anytime soon. So the conclusion here is that dollar will remain strong relative to the rupee. Okay. So when we look at the other way of looking at the same currency pair, here you can see that the rupee is the base currency, meaning say that 1 rupee, how many dollars do you need to exchange for 1 rupee? Here the rupee is constant at 1, and this is the exchange rate that is quoted in the Singapore exchange. And if you want to trade the rupee, okay, to know whether it's strong or weak, you look at the chart, you know that the rupee is weak, because here it's the dollar that changes. Okay, you require less and less dollar to exchange for the same 1 rupee. Now it worth less than 0.02 cents, okay, US dollar cent to exchange for 1 rupee. So you can see that this is how weak the rupee is right now. One look at it, you can see that the outright rupee is down, okay, and it will looks like it will be continuing to go down. Okay, very similar. This is a mirror image of the dollar versus rupee. So the way we look at it in the exchange here in Singapore is that this rupee is quoted what you call that, upside down. Okay, but just understand that whatever currency is on the left, that is the base currency. It will always be 1 unit. They don't change. The rates that changes is actually the quoted currency, which is the right currency here. Now, if you look at the rupee India over time, year to date, this is beginning of the year, and this is where we are as of this afternoon. You can see that the market has attempted to rally, but came off in March of this year, and he has basically doing sideways. Okay, so the market has gone sideways. It has stopped falling. At least not materially. We can say that the market is about 0.12 to 0.1204. Okay, so there is a 400 pips difference in terms of the most recent high and low in the rupee versus the dollar. So how do you trade this? Now, this is based on the currency itself. You can see that this is based on a daily time frame. The market is bearish. That one we don't need to see. We already know that it's bearish. And the point of invalidation is 0.1292 unless price breaks above here, which is highly unlikely. Prices will remain under pressure. And we can see the most recent low here is 0.01193, which is a marginal improvement to where we saw, because this afternoon the price was at 0.01197. So it has bounced off a little bit. So this bounce here is what we call a counter trend move. Okay, so for us, if we are going to trade this currency pair, it's too late to sell because the market has moved so far down already. So the opportunity, in my opinion, here is to look for the lower time frame and to look for things like this. This is a counter trend, and when I go down to the 4 hours, you can see 4 hours I can see a lot clearer. Okay, here I have decided that this is the 4 hours time frame, and the most recent low is over here at 0.01193, and you can see here that the price has did a rebound. Okay, and if price do slide back, okay, if the market do slide back in terms of the rupee versus the dollar to anywhere between 0.1193 to 0.1194, which is 100 pips range here, okay, then I am a buyer. I would definitely be interested to buy because I'm trading the counter trend, because the prices has fallen too fast, too deep, and currency do not go to zero. Eventually, there will be a demand for it. So right now, if I where the market is right now, if the price does drop down to 0.01194 to as low as 0.1193, I will be interested to buy. And the point of invalidation is 0.1193. If the price drop below this level here, then I will take my losses and call it a day and try again another time. But because here, if I can manage to buy it within this bracket of prices, my risk reward is actually very, very good, because this constitutes a 1 unit of risk. From 0.01193 to 0.01194, that represents 1 unit of my risk. If I'm wrong, I lose this amount here. But if I'm right here, it represents 1 unit of potential gain, 2 unit, 3 unit, 4 unit, potentially 5 units of potential gain. Meaning to say that for every $1 I'm prepared to risk, I have potential to make $5. So this is what we call a superior risk reward ratio. Always look out for your relative risk relative to your potential reward. And if we have a risk reward ratio that is 1:5, this is I will buy the rupee anytime within this breakout prices. Because if I'm wrong, I lose 1 unit, which is that means to say I can actually be wrong 5 times, and I only need to be right 1 time. Okay, this is another way of looking at the risk reward ratio.